Hi, welcome back to Beta Accounting Tutor. Today we're going to do a quick video on journal entries. Journal entries are used to record transactions and describe which accounts were used and how. For example, when you're buying supplies with cash, your journal entry might look like this. Now, here's a couple parts that we need to talk about. Supplies and cash are normally asset accounts, which means they have a normal debit balance. That is one of the principles of accounting that you might just have to memorize. Now, with that said, you'll notice that I indented the cash line. On the same note, when you credit an asset account, it means that the account is decreasing. So in this example, our supplies are increasing by $10 and our cash is decreasing by $10 because we are getting $10 worth of supplies in exchange for cash. But if we were to buy supplies on accounts instead of cash, you would just replace this with accounts payable. So in this case, something interesting happens. Now remember that cash is an asset account, but accounts payable is a liability account, which means that when you credit accounts payable, it actually indicates an increase in accounts payable. It just means you owe somebody $10. Now, journal entries are done in dollars, which means if you were to buy, say, 100 pens, you wouldn't write 100 pens and then $10. That does not make sense. Right? So let's look at another example. Suppose you paid off your accounts payable with cash. Then your journal entry might look like this. What this shows is accounts payable, which is a liability account, is being debited $10, which means that it's decreasing by $10, and cash, which is an asset account, is being credited by $10 because we're losing $10 in order to pay this account payable off. Suppose a scenario where person A lends person B $10. So the journal entries for A might look like this. It might be a little bit easier to think about what is going on with cash first. If A is lending B $10, his cash is going down, so the cash account would be credited, and the matching debit is one that describes that the $10 is owed back to him, so it would go into accounts receivable. So you would debit accounts receivable and credit cash. Now, from B's point of view, the journal entry might look like this. B is getting cash, so they would debit their cash account for $10, but they need to pay it back, so the matching credit would go into their accounts payable. Keep in mind that accounts receivable is an asset account, so by debiting it, we're showing that it's increasing. And accounts payable is a liability account, so in order to increase it, we actually credit it. Keep in mind that accounts receivable is an asset account, and by debiting it, we're showing an increase to the accounts receivable, meaning that there is $10 more that is to be paid to us. On the other hand, accounts payable is a liability account, and it is increased by a credit. So by crediting accounts payable for $10, it shows that we owe somebody $10 more than we did before. Now let's talk about when B pays A back. The journal entries for A might look like this. What it shows here is that A is getting cash back, and in return, he is writing off the $10 that was in accounts receivable, so it is no longer owed to him. And B's journal entries might look like this. What this shows is B paid $10 in cash and therefore lost $10 in cash, and in return, B can now write off the $10 that she owes. Before we go, let's talk about adjusting journal entries real quick. Suppose that A pays $600 for insurance for a year on January 1st. On January 1st, A's journal entries might look like this. So we would debit prepaid insurance for $600 and credit cash for $600. Now you might be wondering why we haven't put anything into an insurance expense account. It's because on January 1st, we're paying for the whole year, but as of January 1st, we actually haven't used any insurance to be able to expense it. Now suppose on January 31st, we have to make adjusting entries to show the amount of insurance that needs to be expensed. So between January 1st and 31st, a month has passed. In order to make our adjusting entries, we need to figure out how much a month of insurance is worth. So since we know that we paid $600 for a year's worth of insurance, a month's worth may be 600 divided by 12, since there are 12 months in a year, and that would be 50. So our actual adjusting journal entries might look like this. Keep in mind that expense accounts are used for tracking how much of something we have used. So as we've said before, we don't expense anything on January 1st because we haven't used any of it yet, but on January 31st, we would show the actual expense for the month of January. However, we already paid it in cash, so the money is sitting in our prepaid insurance account, which will now be taken out with a credit. And this journal entry will be repeated at the end of January, February, March, so on and so forth, until all of your prepaid insurance is used up, so December 31st. For our last example, we're going to look at a note payable. A note is a formal debt that is usually issued by a bank. For our last example, we're going to look at interest. Suppose A went to the bank and borrowed $1,000 in exchange for a note payable. The terms are 12% annual interest rate, and it is to be paid back within a year. However, A updates his books every quarter, so after the first quarter, we need to account for interest accrued. Interest accrued is a term used to describe interest that has accumulated but is not due to be paid yet. So let's suppose that this happened on January 1st and look at our journal entry January 1st. So our January 1st journal entry will show cash for $1,000 and a note payable for $1,000. A note payable is an IOU, but it is a more formal contracted IOU. The contract is referred to as a promissory note, and it outlines the details and terms of the loan. Since A updates his books every quarter, interest would not be accounted for until the end of first quarter, which is March 31st. Let's look at our journal entry for March 31st. In order to figure out our journal entry for March 31st, we must first figure out how much interest has accrued within the first quarter. So the way to calculate interest is principal times the interest rate multiplied by the time passed. So in this case, it would be 1,000, which is our principal, multiplied by 12%, multiplied by 1/4, since 1 quarter, 3 months, is 1/4 of a year. We wouldn't write 3 because 12% applies to the whole year, not just every month. So if we put this through the calculator, we find out that our interest so far is $30. So how do we journalize this interest? We would debit our interest expense account for the $30, but since we're not paying it yet, this would go into a payables account called interest payable. So if the terms of the loan stated that interest is to be paid every quarter, then we could very well credit our cash account instead of interest payable. But in this case, the interest will be paid at the end along with the principal, so this goes into a payable. And just as a reminder, principal is the original amount that you borrow. It is the basis upon which interest is calculated by multiplying with the interest rate. So this is an adjusting entry to show accrued interest. We hope you enjoyed this episode of Beta Accounting Tutor, and we'll see you next time. Don't forget to like, subscribe, and we hope to see you soon.
Honestly